We've had some recent news. Obviously, we had a major tax bill passed, the big, beautiful bill, as President Trump calls it. A lot of major reform coming that will benefit real estate. There are some extra pieces of legislation that are being promoted right now regarding limiting paying taxes on home sale profits, as well as some movement in the state of Florida regarding property taxes. So all in all, there is a movement towards improving homeowners' financial positions when it comes to both the tax when you sell and the tax that you pay every year. Great news for homeowners. I think good news for the real estate market is that we'll likely see some movement in a few of those areas. Do I think that we're going to see a blanket abolishment of property taxes in Florida? No, I don't. Do I think that there's a chance that we could see some improvement, some reductions, some increased exemptions, some potential abolishment up to a certain price point and for primary owner occupant homes? I do. And similarly, I could see something happening this year in relation to the $250,000 and $500,000 present exemptions on selling your primary residence. Presently, if you sell your primary residence as a single person and you profit $250,000 or less, you don't pay cap gains tax on that. And if you're married, it's $500,000. Again, 2 out of the last 5 years you have to live in it. It has to be your primary residence. There is some pressure for those numbers to change or go away altogether. I don't see that happening, but I do think there's a chance that number could move up because it's been on the books for about 20 years. Prices have risen, inflation has changed. It is keeping a lot of homes off the market. There are a lot of sellers today saying, I don't want to sell my home because I don't want to pay the taxes on it. And I don't want to sell my home because my interest rate's high, right? Or my interest rate's low, it would be high if I buy. So there's a lot of things holding real estate inventory back and probably artificially making the real estate market worse than it is. And so there is some legislation being proposed to try and improve that. I want to talk next about something that we saw really pick up during COVID, and it is the solution. I want to just let you know this about residential real estate. You're going to see all the pundits and people talk, oh, the market's going to do this, or it's going to crash, or inflation this, which is reduced considerably. The market's going to tank. All these things that people are saying because they look at the past and history. And the past and history says when we have an employment issue, when prices rise too much, when interest rates are too high, people start to have an inability to afford, and then it's a domino effect towards a crashing real estate market. That was the example of the Great Recession. The obstacle and difference today compared to the Great Recession is during the Great Recession, there was very little mortgage underwriting. There was very little done to vet, approve, and confirm a home buyer really truly could afford and had the money to buy the house. There were a lot of liar loans. It was just rampant fraud, as well as the system, because appreciation was so much, the system got really laxed and just wanted to create more loans because that's how banks make money. Well, they learned their lesson because of how bad the Great Recession was, and a lot of the mortgage lenders made major reforms to their underwriting standards, as well as the Fannie Mae, Freddie Mac, FHA, and VA. So today, it's a completely different scenario with how people are able to qualify for a home, how many homes someone can qualify for, what you have to do in terms of proving income, depending on your credit score. It is a lot harder to get a mortgage today, which means that protects the default rate. The default rate and foreclosures are what kill a real estate market. So it's not really the economy or employment or interest rates. It is foreclosures. Because here's what happens with a foreclosure. A bank takes a property back, and then it becomes the low comp for the neighborhood. And then you have a domino effect, banks undercutting each other, a neighborhood losing massive value very quickly while banks try and deploy and get rid of their assets. Well, the financial game completely changed during COVID. And this is why our real estate market will never see a crash like it saw during the Great Recession ever again. We've already seen commercial real estate markets get throttled. We've seen stock markets get throttled, but residential real estate has like a little safety bubble over it. The federal government, not the Fed Reserve, the federal government, the mortgage lenders, the mortgage investors all learned their lesson. So they said, okay, now that we have changed our underwriting standards, what can we do to try and keep people in homes? We had historic increases in appreciation for a several-year period through COVID, and the majority of homeowners out there, even if they struggle making their payments, are not being sent to foreclosure because they have a lot of equity. The banks don't want to own real estate, okay? If you've ever experienced buying or selling or dealing with banks when it comes to residential real estate, whether it's a short sale or foreclosure, it's not real smooth. They're not set up to handle it. They're set up to loan money and to manage money, not properties. So now you have this hedge fund bank network where they trade bad assets to keep them from going to foreclosure, and then having that low comp in the neighborhood pull everything down, which turns into a domino effect and causes other homes not to be able to sell and then not to be able to loan. So now they don't do that. The homes don't go to foreclosure very often. It's very rare. Banks will partner with hedge funds. They'll sell bulk deals to hedge funds. The hedge funds won't report the actual price of that unit because they'll deed it differently. You don't ever really see it. So then regular retail prices don't ever get pulled down. So the banks learned, the investors learned, and now there's way more cash and Wall Street money in real estate purchasing than there ever has been. There are enormous hedge funds that own way more real estate than they ever have that don't have traditional mortgages on them. So because of the number of professional, national corporate hedge fund landlords that are out there, the idea that homes are going to go into foreclosure and then pass to an individual investor in a foreclosure auction is just gone. Not that it doesn't happen. It is just really, really rare. It's why we don't see a lot of foreclosures. So the Fed, the banks, the institutions all figured it out. They keep a protective bubble around real estate. They intertrade the assets so they don't turn into foreclosures and become the low comp, so that they can keep loaning money. And so that you keep a bubble around real estate values, especially with these enormous hedge funds that own the majority of the real estate in the country. So the fix is in, right? The other thing that fixes our residential real estate market from having a crash, and again, having a crash from an economic reason. Our real estate market suffered from the hurricanes, of course. That could certainly cause our market to suffer for a period of time, but not necessarily a crash, not like a national crash. It would be a very hyper-local downturn like we experience. The other tool that the banks and investors use is called a forbearance. What the bank does is they reach out to homeowners, or homeowners reach out to them and say, I'm struggling making my payment. The bank then says, okay, while you get your stuff together, all right, while you get reemployed or handle whatever setback you've had, because you have enough equity, we're just going to take, and the majority of consumers have plenty of equity. We've been so long since we had the foreclosure crisis that equity is way up. The only consumers that are really running into challenges where they could turn into, distressed properties sold on a retail setting, people have bought maybe the last couple of years and then are forced to sell or have to move and don't have money. Are there short sales? Yes. Are there foreclosures? Yes. Is it going to be anywhere near the plethora that we saw in the Great Recession? No. The real estate market is protected. That consumer goes out and the lender says, we're going to let you miss 6 months of payments. We're just going to add it on to the end because you have so much equity. And then they get reemployed. Well, they didn't have this before. So before, when you got behind, it turned into a distressed property. The bank would start foreclosure proceedings. The bank would eat up a bunch of legal fees. Now forbearance, as well as the massive number of financial institutions that are partnered up and connected to banks and have relationships to be able to buy the homes in bulk before they ever turn into a foreclosure. It's a stark contrast to the 2008 financial crisis. Mortgage forbearance wasn't readily available. You didn't have the same equity run-up that you have today. And you certainly didn't have an economy like today where people can get reemployed and catch up. And you didn't have the number of enormous billion-dollar financial institutions that were buying real estate and becoming landlords all over the country. So if you have fear that the real estate market is going to crash and you're going to wait till it does, you're going to wait a long time, because it's not going to crash nationally again. It's just not going to. There's so many protections in place. Other markets could crash. Commercial real estate could have problems like it has the last years, but residential real estate is not going to see a crash. Will you see prices drop? Will you see fewer home sales? Sure. But you're not going to see these years where you see 20, 30, 40% depreciation like we saw during the Great Recession in certain neighborhoods, because the fix is in. They figured it out. They know how to put this protective bubble. They know how to use the equity. The banks don't want the properties back. They don't want to foreclose. They'd much rather issue a forbearance for people that have equity, give them a chance to kind of get back on their feet, keep them in the home so that the market is protected. Their holdings in real estate stay safe so that they can keep loaning on real estate and not have major guideline changes so that they can keep a protective bubble around home values. So again, to summarize, our market's not going to crash. Forbearance protects it. The hedge funds protect it. The amount of cash in the market protects it. And the enormous equity run-up that we had puts most people in a position where they have enough equity to sell and still profit if they absolutely were forced to sell. So I hear a lot of naysayers, oh, the market's crashing and all these indicators of this default and that default. And it doesn't matter. It's fixed. Like they figured it out. It's not pure capitalism in residential real estate anymore. It's a controlled capitalism. There's a protective bubble over it. So hopefully it helps you understand kind of the status of our real estate market. We are seeing fewer home sales. We have seen property values drop a little bit, but we're not going to see a crash. It's just crash has to have foreclosures and we won't have them. They just won't happen.